take a deep breath. Now take another one. Because what you're about to see over the next week is not price discovery. It's not the market calmly revaluing silver. It's a predictable mechanical shock event that gets weaponized every single year by the players who understand flow better than fundamentals. And if you don't know what that means, you will watch a red candle and think the story is over. It won't be over. You'll be watching a trap being set in broad daylight. Welcome back to Money and Empires. Today's breakdown is simple. A massive paper dump is likely coming into the futures market, not because silver suddenly became worthless, but because index mechanics force selling at specific windows. Big money knows the dates. Big money knows the flows. Big money knows where retail fear lives. And big money is counting on you doing what you always do, panicking at the exact moment the machine is designed to make you panic. This video is not financial advice. It's market structure education. Silver is volatile, leverage can destroy you, and narratives are engineered. Our job is to decode the machine so you're not emotionally controlled by it. Now, let's define the headline in plain language. When you hear billions of dollars of selling, people imagine some secret committee deciding silver is dead. That's not how it works. A lot of the biggest selling in the world is dumb money, meaning mechanical money. Index trackers, commodity baskets, funds that must hold what the benchmark holds in the exact weight the benchmark demands. When that weight changes, they rebalance. They don't ask if supply is tight. They don't ask if the world needs silver for electrification. They don't ask if dealers are backordered. They sell because the formula says sell. That's the first key. The selling can be real and still be meaningless. Real flow, meaningless signal. And that's why it gets weaponized. Because when a known finite burst of mechanical selling is scheduled, the sharks front run it. They build positions ahead of the window. They press it during the window. They trigger stops during the window. And then when the forced selling exhausts itself, they flip, cover, and scoop at the discount they helped manufacture. That's not a conspiracy theory. It's how flow-driven markets operate. Now, why does this matter specifically for silver? Because silver is small compared to other asset classes, and it's heavily traded as paper. That means you can move the screen price with contracts, even when the physical world is not selling. So if a big mechanical seller hits the futures market, you'll see it instantly. Price drops. Headlines react. Retail gets shaken. And the same question repeats. Was I wrong? But the better question is, did the physical market change, or did the paper machine just run a scheduled program? Because those are not the same thing. The second reason it matters is timing. These mechanical windows often land right when sentiment is most fragile. After a run-up, near major technical levels, when retail is leveraged, when stops are clustered, when everyone is watching the same support line, that's when a drop does maximum psychological damage. Not maximum fundamental damage, maximum psychological damage. So here's our map for today. Part 2, what the index rebalance flow actually is and how it hits futures. Part 3, how banks and large desks amplify it with stop hunts and narrative pressure. Part 4, what to watch in the real world. Premiums, availability, spread signals, to tell whether the move is real or manufactured. Part 5, the tactical plan for surviving the week without getting emotionally liquidated. And one more thing before we get technical. You do not need to win the candle. You need to survive the machine. The machine is built to transfer assets from impatient hands to patient hands. If you understand the schedule, you stop being the prey. Let S get into the flow event and why billions can hit the market even when nobody is truly bearish on silver. Let's talk mechanics. Commodity indexes are not magic. They're spreadsheets with rules. They hold a basket of commodities, energy, metals, agriculture, and they assign weights. Those weights get recalculated periodically. And at the rebalance window, funds that track the index must adjust their futures exposure to match the new target. If silver's weight is reduced, trackers sell silver futures. If it's increased, they buy. The key point is this: it's not discretionary. It's not someone waking up and choosing to dump silver. It's a mechanical requirement. Now, in most markets, mechanical selling is a shrug. Liquidity absorbs it. Price wiggles, life goes on. But silver is not most markets. Silver is where paper volume can be enormous relative to physical liquidity. So when a large concentrated sell program hits the futures market in a known window, it can overwhelm the bid, push price through key levels, and create the illusion of a thesis collapse. And that illusion is the product being sold to you. Because the best trades don't happen when people are calm. The best trades happen when people are scared and rushing for the exit. Now you might be hearing estimates like around $4 billion of selling. The exact number is less important than the structure. Large, finite, scheduled flow. Even if the final flow ends up smaller or larger, the market often trades the expectation. That's what matters. If traders believe a wave is coming, they position for the wave, and positioning can move price even before the wave arrives. So how does the wave hit? usually through futures contracts. That matters because futures are leveraged instruments. A relatively small amount of capital can control a very large notional exposure. So when an index tracker sells futures, it's not selling bars. It's selling paper claims on future delivery. And paper selling can push the screen price even if physical demand is steady or rising. That's why the disconnect happens. The screen price falls, while the physical buyer in the real world still needs metal. Here's the trap. The public interprets futures selling as, the market agrees silver is overvalued. But the seller didn't do valuation. The seller did rebalancing. So the headline becomes a weapon. Silver is dumping. And the retail mind fills in the narrative. I guess the smart money is leaving. Meanwhile, the actual smart money is watching your reaction and calculating where your stops sit. This is where timing matters. Rebalance windows are like scheduled storms. If you're a sailor, you don't panic at the storm. You change how you sail. You reduce leverage. You avoid putting your ship in a position where one wave sinks you. You don't run into the ocean screaming that the sea is evil. You respect the weather and you manage risk. That's what we're doing here. Now, there's an extra layer. The banks and large desks often know the likely flow distribution across days. They know how these programs are typically executed. Split over sessions, executed with algos, concentrated in liquid hours. That allows them to front run and then press. If you've ever watched silver drop hard at a specific hour and then mysteriously bounce, that's often flow plus positioning plus stop mechanics. Not a sudden revelation about the true value of silver. And because we're in a world where people trade charts emotionally, these moves are extremely effective at forcing weak hands out. But here's the part that should make you sit up. This kind of selling is finite. It ends. The program completes, the forced seller stops, and then the market is left with the same fundamentals it had before, sometimes even stronger because the dip triggered physical buyers to step in. That's why these events can create violent V-shaped recoveries. So if a mechanical sell window is the spark, what turns it into an inferno? Amplification. That's part 3. How the big players turn a scheduled rebalance into a retail liquidation event. Here's how the amplification works. First, pre-positioning. Large desks build shorts into the window, not necessarily because they believe silver is worth less, but because they know near-term flow is selling and price can be pushed. Second, narrative seeding. You'll see notes, headlines, social chatter, and explanations that conveniently appear right before the window. They prime the audience. They make you psychologically ready to interpret red candles as confirmation. Third, level targeting. Markets are not random lines. They're clusters of orders. Retail traders commonly place stop-loss orders under obvious levels, round numbers, previous lows, and major supports. When price approaches those zones during a flow-driven sell program, it's like blood in the water. If you push price just far enough to trigger stops, you create automatic selling. Automatic selling pushes price further. That triggers more stops. And the cascade becomes self-fulfilling. This is how a rebalance becomes a crash. Not because fundamentals broke, but because order flow cascaded. Now add leverage. When price drops, leverage longs face margin pressure. They must post more collateral or reduce positions. Many cannot. So they sell. That's forced selling on top of forced selling. And this is where the machine becomes brutally effective. The screen prints a dramatic drop, and the crowd believes it's a fundamental verdict. But it's not a verdict. It's a liquidation sequence. This is also why the most dangerous strategy in a known flow week is over-leveraging into the move. Because you can be directionally correct on the long-term thesis and still get wiped out by a short-term mechanical event. The machine doesn't care if you're right. The machine cares whether you can survive. Now here's the most important psychological trick they use. They reframe the event as a warning for your safety. They'll say, smart investors should exit. They'll say, this is overextended. They'll say, risk is rising. Notice the language. It's never, we need you to sell so we can buy. It's always, we're helping you. But markets are a two-sided game. If a large institution is loudly telling the public to exit, ask yourself, who is buying what you're selling? Because someone is. And if the selling is happening during a scheduled liquidity event, it's very convenient for the buyer. A buyer needs sellers. A big buyer needs many sellers. And fear is the fastest way to manufacture sellers. Now, let's make this practical. If you see a sharp drop during the sell window and the internet immediately fills with, it's over, don't ask, should I panic? Ask these 3 questions. 1. Is this drop occurring during a known mechanical window? 2. Did anything change in physical availability and premiums, or is this purely screen price? 3. Is the move accelerating because stops and margin are cascading? If the answer is yes, 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 then you are watching the machine run. And when you recognize the machine, you stop letting it hijack your emotions. But you still need a way to separate manufactured weakness from real weakness. That is part 4. We were going to talk about the real-world signals that Don T. Lie. premiums, delivery tightness, and spread behavior between paper and physical markets. If you want a truth filter in the silver market, stop staring only at the chart and start watching friction. Real shortages create friction. Friction shows up as premiums, delays, and spread divergence. In a genuine collapse of demand, premiums usually soften. Dealers discount inventory. Availability improves. The market feels relaxed. In a manufactured paper dump, you often see the opposite. Screen price falls, but premiums stay sticky. Availability doesn't magically improve. Big bars don't suddenly flood the market. The physical side doesn't celebrate the dip. The physical side uses the dip. Now, I'm not telling you premiums will always behave the same way, but they are one of the cleanest reality checks you can use. Because physical buyers don't care about narratives. They care about securing metal at scale. If the physical buyer is still bidding, that tells you something. Another signal is how quickly dips are absorbed. Manufactured sell-offs often leave long lower wicks, sharp down moves that reverse fast. That doesn't prove anything by itself, but combined with sticky premiums, it suggests the market is absorbing paper flow. The third signal is spread logic. If two hubs price physical differently for sustained periods, it implies friction in moving metal or a difference in real demand pressure. In a perfectly smooth market, large spreads get arbitraged away quickly. When spreads persist, it means the easy arbitrage isn't easy. Something is binding. That binding could be logistics, policy, refinery constraints, or simply the fact that paper supply is not the same as deliverable supply. Again, we're not making accusations. We're reading structure. Now, let's talk about the event week itself. During a rebalance sell window, price can get ugly. You can see multi-day pressure. You can see intraday slams. You can see volatility spikes. This is where most people lose, not because silver is dead, but because their position sizing is wrong for the weather. So here are the non-negotiables for survival. 1. Do not confuse temporary flow with permanent trend. The flow ends. The trend is driven by supply-demand reality over months and years. 2. Reduce the chance of forced liquidation. If you are levered, you are vulnerable to being right and still being destroyed. 3. If you're watching this as an investor rather than a day trader, your advantage is time. The machine is built to shake out people who can't tolerate volatility. Time is your edge, not your enemy. Now, I am going to say something that upsets some people. The paper market is not a clean reflection of physical truth in stress periods. Paper markets are excellent at liquidity and hedging, but in a crisis, they can become a theater of psychology. That's why you see sudden moves at thin hours. That's why you see price behave like it's being pulled. That's why people feel like it's unfair. And that's exactly why you need rules. Not feelings, rules. Watch the window, expect volatility, manage leverage, look for reality signals, and remember, a finite forced selling program is not infinite. It ends. Which brings us to part 5, the plan. How to navigate the week, what to ignore, what to watch, and how to avoid becoming the liquidity they need. Here's your framework for the week. Rule 1, do not trade emotion. The machine wants you to react fast. It wants you to hit the sell button during the worst minutes. If you're not a professional with a tested strategy, you don't win by speed. You win by structure. Rule 2, respect the rebalance window. If you know a mechanical sell program is likely hitting futures across a defined period, assume there will be pressure. Assume there will be stop runs. Assume there will be fake breakdowns. The purpose is not to inform you. The purpose is to move you. Rule 3, don't hand them your stops. In flow weeks, obvious stop placements can become targets. If you must use risk controls, use position sizing and time horizon. Don't place your account's fate under the most obvious chart level on the screen. Rule 4, watch for exhaustion. Mechanical selling has a signature. It eventually weakens. The push gets smaller, the rebounds get stronger, the wicks get longer. Volume patterns shift. You can often feel when the forced seller is finishing. That's when the narrative is most bearish, and that's why it's often the most interesting moment. Rule 5, keep your eyes on the real signals. If screen price is down but premiums remain firm, if availability remains tight, if dips are being absorbed quickly, then you're likely watching a manufactured discount rather than a real demand collapse. Now, zoom out to the core idea of this episode. The biggest trick in modern markets is turning a mechanical event into a belief. A rebalance becomes smart money is exiting. A forced liquidation becomes the thesis failed. A stop cascade becomes nobody wants silver. And if you believe it, you will do the one thing they need you to do, provide supply. You become the liquidity. And liquidity is what the other side consumes. This is why these windows exist as wealth transfer moments. Not because you're stupid, because the system is designed to convert fear into inventory. Now here's the conclusion. Even if a multi-billion-dollar paper dump hits the futures market, the selling is finite. The physical story, whatever your view is, does not magically end because a benchmark changed weights. The industrial world doesn't pause its demand because an index pressed a button. The physical buyer doesn't disappear because a chart turned red. What changes is opportunity. Volatility is where disciplined plans beat emotional reactions. Again, not financial advice, but education. Market structure is the difference between panic and clarity. So as we head into this window, keep it simple. Expect pressure, expect narratives, expect volatility. Watch the real-world friction. Manage leverage like your life depends on it. And remember what the machine is trying to do. It wants you gone before the move that comes after the selling ends. Because the moment the forced seller finishes, the market has to breathe again. And when it breathes, it often snaps. If you found this breakdown helpful, hit like, subscribe, and share it with someone who keeps asking, why does silver drop when everything says it should rise? Because the answer is not always fundamentals. Sometimes the answer is the machine. And once you see the machine, you stop being controlled by it.